All right, good evening, everybody. We will go ahead and get started with tonight's webinar. My name is Thomas Wood. I'm the host of the Value Charts Live Trading Room and one of the technical analysts here at Microquant. Tonight we're going to be talking about using low-risk trade entries to increase profitability. And we'll really be covering a couple different topics, but really the main goal of this is how to get into a good trade, know when to get into a trade, where you can use a tighter stop loss and increase your reward to risk ratio without having your stop loss get hit. So that's what we'll be talking about tonight. It's going to be a very interesting topic. We'll do it a little bit different than how we normally do. As you know, we try to keep the Tuesday night webinars to about 30 minutes long, maybe a little bit longer depending on questions at the end. So if you do have any questions, feel free to submit them at any time via the questions tab on your GoToWebinar menu, and I would be more than happy to answer them. First off, just a generalized risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. It's just a general disclaimer. Then again, according to CFTC Rule 4.41, everything that we're showing is hypothetical, although many of the trades were participated in by myself personally and by other traders that I know. We're using them as hypothetical examples tonight. So what's the goal of the strategy? And what's your goal as a trader? And this is, I consider this to be the goal for any trade that I place, and that's to have a much higher reward to risk ratio, meaning I want to have a reward 2, 3, 4, 10, 15 times more than what I was risking. So if I'm risking $100 on a trade, I want to make $1,000, or I want to make at least $200. So that's technically the goal for any strategy, and what we're talking about tonight is how to increase that reward to risk ratio and ways that we can identify a strategic entry point using value and using momentum so that our stop loss doesn't get hit and so that we're not trying to get in too early or get in too late into a trade. So the goal of strategy, what we're going to be talking about tonight, is drilling down and finding a signal within a signal, basically. For example, today with natural gas, we were looking at a short, sent out a short signal in natural gas right towards the end of the day, right before it took that nosedive, via signal feed to all the signal feed subscribers, talking about how it was a bearish divergence. We'll talk about how you could have identified a good entry onto that position so you weren't just trying to jump in while it was still climbing so you didn't get stopped out before it rolled over. We'll talk about how that can increase your reward to risk ratio, and then we'll talk about catching large moves such as 60-minute reversals, risking the same amount as you would with a 2-minute. Again, drilling down and finding a signal within a signal, essentially. Now, there's a couple different rules you need to follow with this strategy. The first is only enter a trade on the proper side of value, overvalued for short and undervalued for longs. Value charts, they're there for a reason. We use them for a reason because by entering at an attractive value level, we know that statistically speaking, we have a much better chance of the market moving in our direction sooner rather than later. So we get into the black, we get into realized or unrealized gains much sooner than if we had just been trying to arbitrarily sell without knowing what the current market value was. So always enter on the proper side of value. I try to do that with every single trade I'm in, even if I have to drill down to a 1 or 2 minute chart to find an overvalued point to short or an undervalued point to go long. Number 2, always drill down to a smaller time frame. If you're in the live trading room, you notice that on almost every single trade that we place, we're looking, okay, we have a 60-minute bearish divergence, so we're looking to go short. Well, what we'll always do 99% of the time, I would say, is go to a 2-minute chart or a 1-minute chart and look for a bearish divergence on a 1 or 2-minute chart. That way we know we can use a much tighter stop loss. We can tell when the rally is coming to an end and get ready to peak and reverse, because it'll show up on the 1-minute chart a lot easier to identify than it will on the hourly or the 30-minute. So rule number 2 is always drill down to a smaller time frame. And then rule number 3 is wait for the MQ regression or MQ momentum to roll over in the direction you want to trade. Now this is what's going to save you from getting in too early while the market's still climbing if you're going short, or while the market is still falling if you're going long. It'll help you get in at the right time so you're not trying to pick that bottom. And actually we're going to be trying to do this a little bit more in the trading room this week. We'll be trading using MQ regression and MQ momentum to time our trade entries a little bit better. So what we'll do, I'll pull up a chart. Like I said, we're going to do it a little bit differently tonight. Instead of just going through a PowerPoint presentation, I figure we can go through and look at some markets today, some trades that we identified today in the trading room and that we identified later, such as the short in natural gas, and we'll look at how we can use this drill down strategy and the momentum and regression line to time our entries into these trades. So we're not trying to essentially pick a top, so we're not getting in too soon or getting in too late. So give me 1 second. Let me pull up TradeStation, and then we will go ahead and start going through these. Alrighty, so you can see my TradeStation screen. Today, first example we're going to take a look at is natural gas. We saw natural gas sold off quite a bit. I sent out the alert via signal feed while this was climbing on the hourly chart. It was moderately overvalued. We were looking at a bearish divergence. So we had lower highs on our momentum indicator, but higher high prices, so we're looking to short. Now the thing is, many traders probably were trying to short. Okay, as soon as we hit overvalued, they're trying to go short. Well, the problem is that market continued to climb for another 10 ticks or so. So if you didn't have a loose stop loss, you missed this entire down move. So what we're going to look at is a couple different ways we could have drilled down to identify when the turning point was actually going to occur. So taking a look at a 1-minute chart, you can see right here, the first thing, remember, looking for the rollover of momentum. So we want to see when momentum starts ticking lower. So we take a vertical bar and put it right there on that bar. You can see that was when the momentum actually ticked to the downside on our MQ momentum indicator. So we're waiting for that histogram bar to tick to the downside, and then we're getting short on the open of the next bar. So that means you'd be going short here on the open of the bar at 3.586, and then you're putting your stop loss at the high or a tick or two beyond that high. So you're putting your stop loss, you're risking $90 per contract with your stop. The market never came back up, and again, you're waiting for the momentum to roll over because that helps you identify when the market is going to continue to sell off. So as soon as it rolled over, we were going short, risking the high. Ended up being a great trade. It continued to sell off. Now, you know how I mentioned before that I only try to enter in the right side of value. So what we could have done, and by waiting to enter in the right side of value, as soon as the momentum rolls over, okay, we wait for the next overvalued price bar to go short, which would have been any of these price bars right here. So we're waiting, momentum rolls over, so it starts ticking lower. As soon as it gets overvalued, we're going short. That's the next option. Okay, so that would have gotten you short around 95 or 3.587. So you were risking about $80 a contract because again, you're putting it just beyond the previous high. Now the next option, remember we talked about rolling over with the regression. So you're trading in their line of regression. So as soon as the regression line rolls over, you are looking to short. So that rolled over right here on this price bar. So you're getting short on the open of the next bar, which was at 3.578. So now you're risking $200 a contract, a little bit less, about $170 a contract with your stop loss. But now your regression line is rolled over, so your trend is now officially shifted and started heading lower. So you got in, you never got your stop loss hit, and you caught this entire downside move until your regression line shifted back to the upside, which was right on that bar there. So you're changing and you're getting out on the open of this bar, 3.515. So from 3.575 to 515. So you took 60 ticks out, or $600 a contract out of that move to the downside, and you only risked a little bit less than 200. So you had a little bit more than a 3-to-1 reward to risk ratio on that trade. Now, we never had to experience our stop loss getting hit. We were patient. We waited for the market to actually roll over, waited to enter on the right side of value. Another thing we can do to really limit when we're getting in, to filter out a bad entry, is if we're only entering on the right side of value, once that market rolls over, we use a longer analysis period, maybe a 14-bar analysis period. And then you're only trying to short if you hit overvalued. So the market's rolled over. Okay, now we're in downtrend officially. So we're looking to short as soon as we get overvalued. The only place we had overvalued was right here. So you would have been getting short right around 3.58, 3.581, because the downtrend has been confirmed because regression is rolled over. We're looking for short opportunities because we had the hourly and the 30-minute bearish divergence where we had higher high prices but a lower high indicator. So we're looking to get short. We wait for the market to roll over to a downtrend with our MQ regression, and then we're shorting as soon as we hit overvalued. So that would have been a great trade there. Again, you're risking about $100 a contract, a little bit more, about $150 a contract. Ended up taking $600 to $700 a contract out to the downside. So very nice reward to risk ratio there, which is what our goal is as a trader, to have nice reward to risk ratios. The other thing you can do is as soon as you hit undervalued, so we shorted at overvalued, as soon as we hit undervalued, right here on this price bar, we move our stop down to break even. So we no longer have our risk on the table. We now have a risk-free trade to try to hold it the entirety of that downside move until it switches back to upward regression all the way down here. Okay, what's the setting for the regression line? I use a 100-bar length on MQ regression. That's a little bit longer term. If you want a more reactive regression indicator, you could change that down to a 75. It gets you short a little bit sooner. Gets you short basically 1 bar sooner. So it's the same thing really. 100 bar I tend to like. It's a little bit less reactive. Helps you catch the bigger moves in the market. So again, wait for the regression to roll over, wait for the overvalued entry, and then get short. Another thing you can do is look at a tick chart, because tick charts oftentimes, even though on a 1-minute chart it looks like this market just sped straight down lower, if we change this to a tick chart, let's take a 100 tick chart for example, and we go back and we look, we can see even though that market just shot straight down, we had all these bounces we could have been trying to short on if we had missed it before using a 5-bar analysis period, where we hit overvalued right here and we hit overvalued right here. So any of these would have been additional entry points we could have used that would not have showed up and did not show up on the 1-minute chart, but on the 100 tick chart it does. So that's another option that you can use. Another market we can take a look at, gold. We were looking earlier today, let me change this to a 1-minute chart really quick. Earlier today we were looking to be long gold, and the reason we were looking to go long gold, which we sent this out via signal feed as well, if you pulled up a 240-minute chart, and we had a trend line coming up across the bottoms. Now we sent this out while gold was right down on the trend line. So if you took that trade, you should be up around $600 a contract, $700 a contract right now. So we were looking for long opportunities in gold. So okay, we have a bullish outlook, so we're looking for a point to get long in this market. What we can do, if we look at a 1-minute chart, we can watch until our momentum rolls over, so we get long as soon as it rolls over to the upside. So it started trending up right around 3.74, so we're looking to buy undervalued. Now when it's really choppy like this, you can use a longer analysis period. So you can use a 10 or 14 or 11-bar analysis period. So once it starts heading higher, we're looking to buy the undervalued points once our regression line turns over. So that gets us long right at around 1.57, and we're risking the lows 1.574, sorry, 15.74 an ounce. We're risking the lows, these previous lows here, so we ended up risking about $70 a contract, a little bit more, because we're doing 2 ticks below this low here. The market rolled over. We ended up taking, if you were still holding it from that entry, it's now all the way up at 78. So you're up $400 a contract, and you risk 70. Another very nice reward to risk ratio. You can also go all the way down to the lows where it was when it was actually on that trend line when we were initially looking to get long. And again, you're looking to buy as soon as the momentum rolls over. So it rolled over here on this price bar. So you can look to get long as soon as it rolls over. And that gets you in on the open of this bar, which is at 73. And you're risking the lows of 71. So you're risking $200 a contract. And again, you took out to the upside now $500 a contract. So a little bit more than 2 to 1 reward to risk ratio there. Now this is a good example of when tick charts come in handy, or when entering on the shift in momentum helps. You can see the momentum actually rolled over right here, and that would have gotten you long on the open of the next bar, which would have been 1572. So that way you would have only been risking $100 a contract, and you would have taken $700 a contract out to the upside there. And again, you're waiting. As soon as that momentum ticks to the upside here on the 1-minute chart, you're buying on the open of the next bar, and then you're holding it until your regression line rolls over. So for this example, you would have held it from 1572, and you would have gotten out as soon as your regression rolled back over up here at 1575. So you would have taken $340 a contract out because it was 1575.40. And again, you're only risking $100 a contract. So it's a very nice move. We're waiting. We have our outlook. We're drilling down to a 1-minute chart, and then we're looking to buy on the shift in momentum or on the shift in the regression line. So as soon as the trend starts heading higher, and then we're risking the low. The goal of this is to make sure that you're not having your stop loss hit, so you're not trying to pick that bottom and then having your stop loss poked and getting knocked out. Now, once again, we can pull up the tick charts. Let's use a 100 tick chart again, and you can look for the entry opportunities here. You can see it started, once it came down, the momentum actually shifted up on your tick chart right there, and that would have had you long from the open of this bar, which is at 71.90. So you're getting a little bit sooner with that bar, and then you catch the rest of that up move. Again, the second option you have is to wait until you get an undervalued entry point, which would have been this point here or any of these points back here, and that would have had you long from 74.30 or any of these undervalued points there. Now again, this is where it helps to use the shorter analysis period, so the 5-bar analysis period. That gets you a lot undervalued a lot sooner than if you're using the longer analysis period. And also, if a 100 tick chart is too long, occasionally it will be too long, and it'll help make you miss moves like this if you're trying to enter on the right side of value. If we change that to a 25 tick or a 50 tick chart, and you go back to where this market started to run higher. Sorry, 1 second. Let me load some additional bars. You can see you dip down into undervalued right there after our regression line started heading higher. Remember, we're looking to buy on the trend line, which was down around 71, 72 area. We're trying to wait until our regression rolls over. So regression rolled over here. We're getting long at the undervalued price point right there where that vertical line is. That gets you long, risking about $100 a contract again, and you catch that entire up move because you're holding it until your regression rolls over, which is all the way up here on the open of this bar, which is 75. So you're long from 72. You're out at 75.20, which is $320 a contract, and you only risk 100. Again, the goal of this is to risk as small amount as possible and yet catch as large of a gain as you can, which is basically your goal for any trade that you're placing. You want to have a high reward to risk ratio. Now, a lot of people ask me, okay, I want to get in on a swing trade. Don't I need to risk more? Absolutely not. In my opinion, you do not need to risk more in order to catch a big move. Like I was saying earlier, all the trades we place in the trading room, we drill down to shorter time frames, which is really what I'm trying to stress here. When you're looking at a market, you have a longer time frame analysis. So we had, for example, here in gold, we wanted to go long gold because we were on the trend line. So we drilled down to the 1 minute chart. We're risking 1 minute risk, where if we're scalping, we're getting out at a couple $100 in profit. If we're going for the swing trade, what we are doing is moving our stop up to break even. So as soon as we hit overvalued, we move our stop up to break even, or as soon as we're up $100 or $200, stop goes break even, then you just let it ride. You let the market, you let it run until you reach your 240-minute profit target, which would either be overvalued, breaking through that 8 EMA, or if you're trying to hold it even longer term, up into the resistance levels at about 1586, or even higher, 15 or 1620 at those highs from last week. So again, you don't have to risk more just because you're trading a swing trade. You can still risk a small amount because you're drilling down, entering on the right side of value, looking for the signal within a signal that helps you not have to risk as much, and you can still catch the big moves. Like I said in the PowerPoint, you're catching the 60-minute move off of the 1 minute entry with the 1 minute risk. So that's really all we had for today, really basic. Like I said, we try to keep these webinars simple, to the point, about 30 minutes in length because we want to respect your time. The key points from tonight's workshop or presentation is really drilling down. You're looking to find the signal within a signal. So if you're trading a bullish divergence or a bearish divergence, you're looking for a divergence within a divergence. The other options are waiting until your momentum shifts, which filters out a lot of trades or a lot of bad trades. So instead of trying to trade all these divergences here, you're waiting until your regression line rolls over. I apologize, I said momentum. You're waiting for your regression to roll over, then you're going long, and you're trading the direction of the 1 minute regression off of the 240-minute signal. The second option is trading with momentum. And another thing you can do with momentum, and this actually works very well in my opinion. Let's go back to a 25 tick chart. I know I said we were almost done, but this is something worth showing, I believe. 1 second, let me load the additional bars back. So we'll go back again to that same trade where we're looking to go long. We're looking at a 25 tick chart. You can see our momentum's kind of crazy right now. We're having a lot of upswings and downswings because that's a very reactive momentum. What we can do is smooth out the momentum indicator. So we'll change the indicator line to 50. We'll change our smoothing to 25 or so, and change our signal line to about 7 or 8. You can see that smooths out the momentum a lot better. And that way, you're waiting to enter as soon as that momentum rolls over. So the momentum rolled over right there. We're looking to enter on the open of the next bar. So the open was 1571.70, and we're risking the lows, which is 1571. So it's a tick or two below the lows. So we're risking $70 a contract, and then we can hold it the entire time, either for the regression line or the momentum line. So as soon as momentum shifts back to the downside, which is right there, we're getting out on that open, which is 1574.90. So you took about 300 and some change out of there per contract. Now what we can do, I'll go through and answer some questions. Again, really quick to touch on the key points. You're drilling down to look at either tick charts or 1 or 2 minute time frames, even if you're trading in longer time frames, so that you don't have to risk as much. You're either filtering out your entries based on entering at the attractive value level after momentum has shifted, entering as soon as momentum shifts with a smoothed out momentum indicator, so a longer analysis or a longer settings on your MQ momentum indicator, or you're entering as soon as your regression rolls over from a downtrend to an uptrend. So you want to catch the upswing. The whole goal of that is to get in as soon as the momentum starts heading higher so that the market never comes down and hits your stops. Because what happens to a lot of traders, they'll say, oh goodness, it's coming down to that trend line, you need to get in. They'll put their stop in right here. They'll get stopped out right at the low. And we don't want to see that happening. That's why being patient, waiting for it to actually roll over and head in your direction is a lot better oftentimes for filtering out when to get in, when to get long, when to get short. So now I'll go through and answer some questions very quickly. Can I tell you how to increase the width on value bars? Absolutely. This is for TradeStation anyway. If you go to Format Analysis Techniques, so you right click on your screen, Format Analysis Techniques, you're going to go to Value Bars, you're going to format them. If you go over to the tab that says Style, you'll see an entire list of things that are called plots. It'll say V open, V high, V low, V close, etc. If you look over on the right hand side, you can see the weight, and you can adjust the weight of all those to as fat or as skinny as you'd like. You have to go through each one and change this weight for every single one to make it fatter or skinnier. And I'll do that really quick so you can see the difference that it will make on the size of the value bars. Makes it a little bit easier to see. Again, the way that you're doing that is you're going right-clicking, going Format Analysis Techniques, going to Format Value Bars, going to the Styles tab, or the Style tab, and then you're changing each one of the plots to a thicker weight. Just about done. Takes a minute because there's a lot of them. And as soon as you do that, you can see it made them much, much thicker. It's a little bit harder to read them, so you want to spread them out a bit more. But you can see just how much thicker they actually got. It makes it a little bit easier to see. Next question. On the MQ momentum indicator, do I use solid blue line and the dotted yellow line as a divergence indicator? Yes, I use the blue line and the yellow line together. So basically I look at them as one line. So here's the low here and here's the low there. So you had a slight bullish divergence here where you had a higher low on your indicator. Here's your second low, and here was your first low. So you can look at the dotted lines that way. I normally look at the histograms though and judge my divergences off the histograms. If I get the histogram and the indicator line to work together, oftentimes that's a much better signal. For example, right here, where you had a lower low prices but a higher low histogram, that would have been okay to get long here, and then you cover at the highs. And again, if you want to be a little bit more conservative with your value, change your analysis period to a longer analysis period. That'll do a much better job of filtering out all the noise and helping you actually identify the overvalued highs and the undervalued lows. Do I find all of these trade opportunities by scanning? No, I don't use a scanner for the trades that we place in the trading room. For the trades I place, I use discretion. I go through and I look at the markets, I see what they're doing, and then I place trades based off of what I'm seeing. So, for example, in the trading room, we have a whole list of futures that we follow. We'll go through and we'll look at each one. So, for example, we're looking at crude right now. We'd say, okay, don't see a specific trade opportunity, maybe forming a bearish divergence right now on this 25 tick chart, but I'm not going to take a short off of that because it looks bullish overall on the 240 and the 60. So I just scan through and look for the opportunities based on discretion, and then drill down and pinpoint my entry opportunity. If it breaks the trend line significantly, should you still follow through with the trade? Are you talking about gold? If gold broke through that trend line significantly? No, I personally wouldn't try to continue to go long. If it broke through that trend line and came all the way down to say 1667 or 1567, 1568 or so, all the way down through those lows, I would say that trend line is no longer a valid support level. I would consider it potentially resistance, so I'd watch for a retest of it, but I wouldn't still be trying to go long off of the trend line. Now, I might still be trying to go long off of a support level from the lows on Monday, but I would not be going long off of the trend line. The drill down time frame low may not be the higher time frame low. How does this affect the initial stop loss? I'm not sure what you mean by that, sorry. So if I drill down here, for example, when we had this bullish divergence here, we're looking to get long, and it still went down another few ticks or so below this. Is that what you're asking? How does that affect the stop loss? So we drilled down, it rolled over to upside momentum, so we were getting long. As soon as I hit overvalued, I put my stop loss at break even. So, for example, as this was rolling over, our momentum rolled over. Also, our regression line rolled over. Momentum rolled over all the way back here, so we were long from the open of this bar with our stop below the low. As soon as it got all the way up here and significantly overvalued, I would have been moving my stop up to break even. Or even if it just hit moderately overvalued, I would normally be moving my stop up to break even. I try to get it up in break even as soon as I'm up about $100, $200 a contract, which in this case you would have been up from the open of this bar. So 71. At one point you would have been up a little over $100 a contract, up about $150 a contract. I would have had a break-even stop in place there. Would have been stopped out break-even, and then tried again if I was still looking for that to catch the longer move. That's what I'm saying. With a swing trade, you move your stop to break-even, and then you try to let it run. If you catch it right, which is what you're trying to do by drilling down, you can see when you caught it and it actually ended up being the bottom and you were trying to swing trade, it just took off and never looked back. So it just continued to climb, and it never would have hit your stop loss. You could have moved your stop up to break even, and you would have been in good shape for the rest of that up move. So if you're right on the trade, it should not, technically speaking, come back. Same thing goes for natural gas. We can go back and look at natural gas right before it took that nosedive all the way back here. If you caught it right, which look at this great 25 tick bearish divergence right there that would have gotten you short natural gas from 583. But if you catch it right from the high, as soon as it rolls over and you're short, it should never come back up and hit your stop loss. It should just continue to head lower the entire time and not come back up. So as long as you're correct in the direction that the market's going to be going, you have your break-even stop, you should be in good shape. The tick chart use and other indicator changes you make are different for each market. Tick charts, it depends on your trading style. Tick charts are very, very reactive. So you can trade off of tick charts. You can also use a little bit longer of a time or a longer number of ticks for your tick charts if you want to do that. But they're much more reactive. If you're using a time-based chart, then you'll know actually when that bar interval is going to end, so you can actually time it. That's one of the advantages of using time-based charts. But I don't change my MQ regression. Is going to stay the same at 100. My momentum indicator is going to stay the same whether I have it smoothed out or set to default. So I don't change the indicators there. I normally try to use a longer analysis period if I'm using a tick chart compared to if I'm using a time-based chart for my value bars indicator. Larry, we can try doing that. In the trading room, where you know ahead of time what trades we're contemplating on and be able to enter as close as possible to your entries, but harder, of course, for markets like crude. Absolutely, Tony. In the trading room, the way that I try to do the trading room is I talk about every single trade opportunity I see developing. So we'll go through and we'll look at all the markets, and I'll say, okay, we could potentially be looking for shorts here. We'll potentially be looking for shorts there. We're looking for longs here, et cetera, et cetera. I'll tell you what I see developing, and then I'll say, okay, I'm looking to get short right now, or I am getting short right now, and you'll see why. I'll explain why as I take the trade or when I take the trade, because my goal as the host of the Futures Trading Room is to help you understand how to use our indicators better and the best way to trade with our indicators. I want to help you become a better trader. All right. Well, if there's no more questions, that's going to conclude today's webinar. I want to thank everybody for coming. I want to mention very quickly, Mark's webinar, Mark's workshop starts tomorrow. He's going to be talking about coding automated strategies. He's going to teach you how to code. No experience in coding or tech savvy or anything like that is required. It's going to be for, he's going to teach you from the basics all the way through how to do it. You can sign up for that at valuecharts.com. It's going to be a great workshop. I'm looking forward to it because I personally am not a coding genius or anything like that, so I plan on learning a lot. And Mark is the guy to talk to about that. He is one of the best coding or strategy developers I have ever met. He's also going to be giving away a few free strategies for those that, well, not free, but for those that attend the workshop. He'll be giving away some of the strategies that he's coded, and he's also going to be helping you, walking you through coding them in the workshop itself. And that starts tomorrow. You can sign up for that at valuecharts.com. Look forward to seeing everyone there. I look forward to seeing everybody in the trading room tomorrow as well. What's the purpose of designing a trading system? Automated trading strategies help take the emotions out of trading. There's some that I use personally in my personal account that Mark has coded, where I'm looking to go short. Instead of having to personally discretionary place the trade, I'll turn on the strategy that's a short strategy that as soon as that market starts heading lower, it'll manage that trade for me and it'll keep me in the trade longer term, and it will kick me out once the trend ends, that sort of thing. So automated strategies are amazing. They help take out, like I said, the human error portion of trading, get rid of the emotions, which is one of the biggest killers of account values. Again, that concludes tonight's webinar. I want to thank everybody for coming. Look forward to seeing many of you in tomorrow's live trading room. So have a great night, and I will see you next week at the next free webinar.